Welcome to our deep dive on high-income retirement strategy and the question, are you using your IRAs backwards? In this video, we will explore how high earners can structure contributions to minimize taxes now while still building tax-free growth for the future. We will focus on the order of operations, how the Backdoor Roth IRA works, and the crucial IRS Pro-Rata rule that can make or break your strategy. We will also cover steps to execute a clean Backdoor Roth and avoid common mistakes. Let's begin by outlining what we will cover today. In today's agenda, we will start by explaining why order of operations matters for high-income earners. Next, we will explain the Backdoor Roth IRA in simple terms. Then, we will address the IRS Pro-Rata rule and how it creates unexpected tax consequences. After that, we will walk through a clean setup step by step. We will also illustrate the math behind the Pro-Rata calculation with a visual example. Finally, we will review key limits, highlight common pitfalls, and finish with a short quiz to test your understanding. Here's the core problem. If you are a high earner, you may exceed the income thresholds for direct Roth IRA contributions. Because of this, you need to be especially strategic with the order in which you save. Prioritizing pre-tax savings can reduce your adjusted gross income, which affects your tax bracket and phase-outs. Meanwhile, the IRA space is typically used for the Backdoor Roth maneuver. However, this clean strategy often gets derailed by the IRS Pro-Rata rule when existing pre-tax IRA balances are present. Understanding this interaction is essential to avoid paying unnecessary taxes. First, prioritize maximizing your traditional 401k. This immediately lowers your adjusted gross income and can prevent you from creeping into higher tax brackets or triggering phase-outs. Next, if you are HSA eligible, contribute the maximum to your health savings account, as it offers triple tax advantages. After that, reserve your IRA space exclusively for executing a Backdoor Roth IRA. This means making a non-deductible contribution to a traditional IRA, and then immediately converting that amount to a Roth IRA. However, to avoid unexpected taxes, you must ensure that you have no pre-tax balances in any traditional, SEP, or SIMPLE IRA at the end of the year of conversion. If you do have pre-tax IRA money, a protective step is to first roll those balances into your employer's 401k, which is not aggregated for the pro-rata calculation. By following this order of operations, you align tax reduction now with tax-free growth later. This mind map visually organizes the pro-rata rule. At the center is the Pro-Rata rule itself. One branch shows that the IRS aggregates all of your IRAs, including traditional, SEP, and SIMPLE, when computing the taxable portion of a conversion. Another branch shows the taxable portion formula, which is the pre-tax balance divided by the total IRA balance multiplied by the amount you convert. A separate branch emphasizes the importance of tracking after-tax basis using IRS Form 8606. Another branch highlights timing, explaining that the year-end balances across your IRAs are what matter for the aggregation. The avoidance strategy branch emphasizes rolling any pre-tax IRA balances into an employer 401k plan prior to doing the Backdoor Roth conversion, so that those pre-tax dollars are removed from the aggregation. The common mistake branch notes that converting while holding pre-tax IRAs leads to unexpected taxable income. Finally, the outcome branch reinforces that misunderstanding these rules can create immediate and avoidable taxes. To execute a clean Backdoor Roth, start by confirming that your income exceeds the direct Roth IRA contribution limits and that you want Roth exposure for long-term tax-free growth. Then, prioritize maximizing your traditional 401k to reduce your current year tax liability. Next, check for any pre-tax balances across traditional, SEP, or SIMPLE IRAs. If any exist, roll those balances into your employer's 401k plan before doing the conversion. After that, ensure you have both a traditional IRA and a Roth IRA open, ideally at the same institution for easy processing. Make a non-deductible contribution to the traditional IRA and record this basis on IRS Form 8606. Immediately convert the same amount into the Roth IRA to minimize any earnings that could complicate taxation. Finally, invest the Roth funds in alignment with your overall strategy and keep all documents and statements organized for accurate tax filing. Let's quantify the pro-rata rule with simple numbers. Suppose you have $95,000 of pre-tax IRA money and contribute $6,000 as a non-deductible basis this year. Your total IRA balance is $101,000. If you convert $6,000, the taxable portion is the pre-tax balance divided by the total balance, multiplied by the conversion amount. That is $95,000 divided by $101,000 times $6,000, which equals approximately $5,644 that is taxable. Only about $356 would be considered the non-taxable return of basis. The pie chart highlights how small the after-tax portion is relative to the pre-tax portion. The key takeaway is that if you do not remove pre-tax IRA balances before converting, most of your backdoor Roth conversion is taxed now. Here is a quick reference for common contribution limits as of 2024. The 401k employee deferral limit is $23,000, with a $7,500 catch-up for those age 50 or older. Traditional and Roth IRA contribution limits are $7,000, with a $1,000 catch-up. Health savings accounts have limits of $4,150 for single coverage and $8,300 for family coverage, with a $1,000 catch-up. Always verify the current year limits, since they are periodically adjusted for inflation and may change after this recording. On the left is the clean backdoor Roth approach. You first eliminate any pre-tax IRA balances by rolling them into your employer 401k, then make a non-deductible contribution to a traditional IRA and convert immediately. This typically results in little to no taxable income on the conversion and keeps things simple for repeatable use in future years. On the right is the messy path. If you convert while holding pre-tax IRA balances, the IRS Pro-Rata rule aggregates all IRAs when determining the taxable portion, making most of the conversion taxable and adding complexity to your tax filing with Form 8606. The clean path preserves the intended benefit of tax-free Roth growth without a surprise tax bill. Quiz question. You have $80,000 in pre-tax IRA money and add a $7,000 non-deductible contribution. If you immediately convert $7,000 to a Roth IRA without moving pre-tax funds to a 401k, approximately how much of that $7,000 is taxable under the pro-rata rule? Options are about $6,440 taxable, about $5,000 taxable, about $3,500 taxable, 0 taxable. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is about $6,440 taxable. The total IRA balance is $87,000. The taxable portion is the pre-tax balance divided by the total balance, multiplied by the conversion amount. $80,000 divided by $87,000 times $7,000 equals approximately $6,440. The non-taxable portion is roughly $560. Second quiz question. What is generally the recommended order of operations for high earners seeking tax efficiency and Roth exposure? Your options are Max Roth IRA directly, then Max Roth 401k, then HSA, Max Traditional 401k, then HSA if eligible, then Backdoor Roth while ensuring 0 pre-tax IRA balances, Backdoor Roth first, then Traditional 401k, then HSA, or invest in taxable first, then Backdoor Roth, then Traditional 401k. You may pause the video now to consider your choice. We will share the correct answer in the next section. The correct answer is to maximize the Traditional 401k first, then contribute to an HSA if eligible, and then execute the Backdoor Roth with 0 pre-tax IRA balances. This order maximizes current year tax savings and ensures that the Roth conversion is clean and efficient. Here are common pitfalls to avoid. First, do not attempt the Backdoor Roth while holding pre-tax IRA balances, as the pro-rata rule will create a large taxable amount. Second, avoid waiting too long between the contribution and the conversion, because any earnings during the wait may become taxable. Third, make sure to properly complete Form 8606 to track your non-deductible basis. Fourth, confirm that your employer 401k plan accepts roll-ins from IRAs before initiating a rollover. Fifth, do not skip maximizing your pre-tax 401k contributions if your goal is to lower current year taxes. Finally, coordinate timing with bonuses, restricted stock vesting, and withholding adjustments to prevent unnecessary movement into higher tax brackets. Here is your action checklist. First, confirm whether you exceed the Roth IRA income limits and understand your current tax bracket. Next, maximize your traditional 401k to reduce your adjusted gross income. If eligible, contribute the maximum to your HSA for its triple tax benefits. Then, clear any pre-tax IRA balances by rolling them into your employer's 401k plan. After that, execute the Backdoor Roth promptly and ensure that Form 8606 is filed to document your basis. Finally, invest your Roth funds according to your long-term allocation and rebalance as needed. Before we wrap up, here is an important disclaimer. This video is for educational purposes only and does not constitute tax, legal, or investment advice. Your situation is unique, and tax treatment can change based on your income, state, plan features, and timing. Consult a qualified CPA or financial advisor before implementing any strategy discussed here. To summarize, the order of operations matters greatly for high-income earners. Prioritize your pre-tax 401k, then an HSA if you are eligible, followed by a Backdoor Roth. The IRS Pro-Rata rule aggregates all IRAs, so remove pre-tax IRA balances before converting. Track your basis with Form 8606 and keep thorough records. Verify contribution limits each year and coordinate the timing of rollovers and conversions. Ultimately, the goal is to achieve long-term tax-free growth in your Roth accounts by executing a clean, compliant process. Thanks for watching. If this video helped, please like it, share it with a friend, and subscribe for more smart money strategies. Share your questions and experiences in the comments so we can learn together. See you in the next video.